Hello, and welcome to your daily market briefing. Today is Friday, November 14th, 2025. We are tracking a significant wave of risk aversion sweeping across global markets. The past 24 hours have been defined by a sharp, AI-led technology sell-off in the United States, which has now rippled through Asian and European trading sessions. Compounding this is a major reassessment of interest rate expectations. Hawkish commentary from several Federal Reserve officials has all but erased market hopes for a December rate cut, sending shockwaves through equity, bond, and currency markets. Let's begin with the key market levels. Global indices, a sea of red. The snapshot of global indices tells a clear story of a market under pressure. We'll start with the U.S. market close from Thursday, November 13th, which set the negative tone for the entire globe. The S&P 500 plummeted 113.43 points, a fall of 1.7%, to close at 6,737.49. This was its worst single-day drop in over a month. The Dow Jones Industrial Average was not spared, shedding 797.60 points, also a 1.7% decline, to end the day at 47,457.22. But the epicenter of the sell-off was the tech sector. The Nasdaq Composite cratered, losing 536.10 points, or 2.3%, to close at 22,870.36. This negative momentum carried directly into the Asian session today. In Japan, the tech-heavy Nikkei 225 fell by 1.8%. South Korea's Kospi was hit hard, plunging 2.6%. In China, the CSI 300 was down 0.7%, and Hong Kong's Hang Seng dropped 0.9%. Australia's ASX 200 also finished 1.5% lower. As the European session is underway, the losses continue. European markets are slipping from recent record highs, with both the DAX in Germany and the CAC 40 in France trading in negative territory. The UK's FTSE 100 is also down. In India, the Sensex and Nifty 50 are both down approximately 0.3% in afternoon trade, with markets also digesting local election results. Macro drivers, the why behind the sell-off. There are two primary catalysts driving this global rout. Driver 1, the AI bubble valuation check. The tech-heavy Nasdaq's severe underperformance was not random. It was a direct response to growing fears that the artificial intelligence stock boom has gone too far, too fast, drawing comparisons to the dot-com bubble of 2000. The primary trigger was a report that Japan's SoftBank has sold its entire stake in AI darling Nvidia. This news sent a shockwave of fear through the semiconductor industry. Nvidia itself, a $4.5 trillion company, fell 3.6%. This dragged down other major chip makers. South Korea's SK Hynix fell over 6%, Samsung Electronics dropped 4%, and Taiwan's Semiconductor lost 1.8%. Investors are no longer buying the dip indiscriminately. They are actively questioning the sustainability of these high-flying valuations. Driver 2. The Fed slams the door on a December cut. The second, and perhaps more powerful, driver is a dramatic shift in interest rate expectations. For weeks, the market had been confidently pricing in a Federal Reserve rate cut in December. As of today, those odds have collapsed to what is essentially a coin toss, at or below 50%. This is a direct result of a coordinated chorus of cautious to hawkish comments from regional Fed officials. Neel Kashkari of the Minneapolis Fed stated that he sees inflation at 3% as high and remains undecided on a December cut. Fed Governor Adriana Hammock suggested policy must remain restrictive due to persistent inflation concerns. Fed official Musalem explicitly advised caution on any further rate cuts, pointing to tepid business investment. And Mary Daly of the San Francisco Fed rejected any notion of raising the Fed's 2% inflation target, cementing the bank's commitment to fighting inflation. The message is clear. The Fed is not convinced its job is done, and higher for longer is back on the table. Major economic data releases. New economic data from around the world is only adding to the gloomy sentiment. From China, economic activity cooled more than analysts expected. The most alarming figure was fixed asset investment, which shrank by 1.7% in the first 10 months of the year, a record decline. Industrial production also slowed, growing at 4.9%, its smallest gain this year. This data points to significant weakness in the world's second-largest economy. From the United Kingdom, the UK economy is stagnating. Third-quarter GDP growth came in at just 0.1%, missing the 0.2% forecast and slowing from 0.3% in the previous quarter. The manufacturing sector was a particular weak point, contracting by 0.8%. From India, in contrast, India's wholesale price index for October showed deflation, with prices falling 1.21% year-over-year, driven by lower food and crude petroleum prices. From Hong Kong, the government released its Q3 economic report, showing the economy grew by a robust 3.8%, picking up from 3.1% in Q2, driven by strong exports and tourism. The political and geopolitical landscape. On the political front, several key events are impacting markets. 1. U.S. government shutdown ends, but data is lost. The prolonged U.S. government shutdown officially ended on Thursday after President Trump signed a short-term funding bill. While this removes one layer of uncertainty, it has created a new one. The government is now preparing to release a backlog of delayed economic reports. However, the White House has warned that some key October data, potentially including the all-important jobs report and CPI inflation data, may never be published, as the agencies were unable to collect the data during the shutdown. This leaves the market and the Federal Reserve flying blind on some of the most critical economic indicators. 2. G7 foreign ministers' joint statement. A G7 foreign ministers meeting just concluded, and their joint statement has several market-relevant takeaways. On China and Russia, the G7 strongly condemned China, North Korea, and Iran for providing military assistance and dual-use components to Russia for its war in Ukraine. On the Middle East, the ministers reaffirmed their strong support for President Trump's comprehensive plan to end the Gaza conflict, welcoming the current ceasefire and the release of hostages. On supply chains, the G7 expressed particular concern over China's use of non-market policies to disrupt critical mineral supply chains, signaling ongoing trade tensions. 3. UK tax policy shift. In the UK, reports indicate that Prime Minister Starmer and Chancellor Rees are set to abandon planned increases to income tax in their upcoming budget. This fiscal U-turn is being watched closely, as it has put downward pressure on the British pound. Commodities and bonds. The market's reaction. The reaction in other asset classes has been just as pronounced. Oil prices rebound sharply. After slumping 4% earlier in the week on fears of a global oversupply, which was echoed by new reports from both OPEC and the IEA, oil prices are rebounding strongly today. WTI crude is up over 2%, trading back around $60 per barrel. Brent crude is also up over 2%, near $64 per barrel. This rebound is not based on demand, but on new supply risks. The market is bracing for upcoming U.S. sanctions set to begin on November 21st. Reports indicate that Russia's Lukoil is already cutting trading staff, and a significant portion of Russian oil exports are currently stuck in tankers, tightening near-term supply. Treasury yields march higher. In the bond market, the reaction to the Fed's hawkish shift is unmistakable. The yield on the benchmark 10-year U.S. Treasury note has pushed higher, rising to 4.12% on Thursday and holding firm above 4.1% today. Remember, when bond yields rise, bond prices fall. This is the market selling off bonds as it adjusts to the new reality that interest rates are likely to stay higher for longer. This rising risk-free rate makes borrowing more expensive and puts direct downward pressure on stock market valuations, especially for growth and tech stocks. Cryptocurrency update. The risk-off sentiment has also spilled over into the digital asset space. Ethereum and major altcoins are under significant pressure, seeing broad-based declines as investors flee from more speculative assets. In related news, the G7 foreign ministers' statement specifically expressed grave concern over cryptocurrency thefts being conducted by North Korea. And in corporate news, Bitcoin and Ethereum mining company Bitmine Immersion Technologies announced the appointment of a new CEO and 3 new independent board members as it continues to restructure its operations. Concluding summary. To summarize the last 24 hours, market sentiment has turned decisively negative. A long overdue valuation check on the AI and tech sectors, sparked by SoftBank's sale of Nvidia, has initiated a broad sell-off. This was amplified by a hawkish pivot from Federal Reserve officials, who have effectively dashed hopes for a December rate cut. Weak economic data from China and the UK has further soured the mood, and the end of the US government shutdown has created new uncertainty about missing economic data. All eyes will now be on the delayed data that is released, as the market desperately searches for a clear direction on inflation and economic growth. This concludes your market and macroeconomic briefing for November 14th, 2025.